Okay, let's unpack this. We're about to take a deep dive into a company really at the intersection of autonomous tech and, well, potentially massive market growth. Aeva Technologies, ticker AEVA.
Right.
In a world just swimming in information, our mission here is pretty simple. Give you a shortcut, a real shortcut to being truly well-informed. We're pulling the most important nuggets, the key insights from a stack of articles, research, notes about this specific company that you've actually shared with us.
That's right. Think of us as guides through all that material. We'll help you understand the critical pieces, AEVA's unique tech, its financial standing, who's backing it, and, the big picture opportunities and risks.
We're going to explore AEVA Technologies using analysis structured into 7 key chapters, all drawn directly from the material provided. This first part, we'll tackle the core business, the management team, and its current financial health. By the time we're done, you should have a much clearer perspective on what the market thinks about Aeva, whether its, frankly, high valuation might actually be justified by its future potential, and also the significant hurdles it still needs to clear.
Yeah, it's all about getting to those aha moments from the sources quickly and clearly.
Exactly. And speaking of getting insights quickly, if you're finding this deep dive valuable, the best thing you can do, like and subscribe to the stockanalytics.ai YouTube channel.
Definitely.
That tells us these deep dives are hitting the mark for you. And for our members, it's just $4.99 a month. You get the awesome benefit of suggesting tickers for future deep dives. We prioritize those. So join up. Let us know what you want us to explore next.
All right, ready to jump into chapter 1 then?
Absolutely. Let's get started.
Yeah.
Chapter 1, Business Understanding.
Okay, so at its heart, Aeva designs and sells advanced LiDAR sensing systems. That's light detection and ranging, plus the perception software that makes sense of the data. The company was founded back in 2017 by 2 former Apple engineers, actually, from that very secretive special projects group. So they bring that Silicon Valley DNA.
And their big innovation, the core thing, is something called 4D LiDAR on chip. Now, most LiDAR we hear about uses time of flight. Tough, right?
Correct.
That measures how long light takes to bounce back,
Mm-hmm.
gives you 3D position. So what makes Aeva's 4D different? What's the aha here?
The crucial difference, the real innovation, is their use of FMCW technology, frequency modulated continuous wave.
Okay, FMCW.
Yeah. Instead of just sending out pulses of light, they use a continuous laser beam. And by analyzing the change in frequency of that light when it comes back, well, their sensors can measure not just the object's 3D position, but also its instant velocity.
Ah, instant velocity.
Yeah.
How fast it's moving towards or away from you?
Exactly. Directly. That's the critical 4th dimension, something traditional TOF really struggles to get directly and instantaneously.
So the aha isn't just like more data points. It's fundamentally more useful data for autonomous systems.
Precisely. Knowing that instant velocity means a self-driving car or maybe an industrial robot can make faster, much higher confidence decisions about things that are moving. Is that pedestrian stepping out? Is that car speeding up?
Right.
It changes the game. Instead of just knowing where things are, you know how they're moving right now.
Got it. That makes sense.
Yeah.
So they've turned this tech into actual products. What are they selling?
Well, their flagship is Atlas. That's designed specifically for the automotive world, highway speed, automated driving, that kind of thing.
Dumb.
They also have Aries to second. That's an earlier generation, used more for development now, and some non-automotive stuff.
Uh-huh.
And importantly, they just launched Eve 1. That's a new line aimed squarely at the industrial automation market. Things like high-speed inspection, quality control.
Interesting. Their business model is described as asset light. What exactly does that mean? Is there a downside?
Asset light basically means they focus on the high-value stuff, the IP, designing the tech, the complex silicon photonics chips. They don't build their own giant, expensive factories.
Okay.
Instead, they partner with established, high-volume manufacturers, which lets them scale up production without massive capital spending. Great for flexibility.
But the trade-off?
The trade-off is, well, they rely on these third-party suppliers. That introduces potential supply chain risk, which we should probably touch on later. Revenue comes from selling the hardware, licensing their software, and professional services for integration help.
Okay, let's talk market size, the potential playground here. Total addressable market, PAM. How big could this get?
Well, just the automotive LiDAR market is pretty significant and growing fast. Sources projected it could go from, say, $1.6 billion this year, 2025, up to over $10.5 billion by 2034.
Wow.
Yeah, that's a compound annual growth rate, CAGR, of over 23%, driven by, autonomous vehicles, advanced driver assist systems.
But they're not just looking at automotive, right? They're expanding that TAM.
Absolutely. The industrial automation market is huge. Just
Mhm.
for the kind of laser displacement sensors EVE-1 could replace or improve, that's estimated at over $4 billion.
Right.
Plus, they're eyeing consumer electronics, think AR/VR national security, even aerospace. They've got that collaboration with Airbus on automated taxiing.
This move into industrial automation feels pretty strategic. Why do that if automotive is the really massive long-term prize?
It's a smart move, actually, a de-risking play. Automotive design cycles, they are incredibly long.
Right. Takes years.
Exactly. Revenue from their big deals, like that top 10 global OEM, not expected until 2027 earliest. That's a long time to keep funding heavy R&D.
Mm-hmm.
So the industrial market, it offers a potentially faster path to revenue, often higher margins, quicker sales cycles too. It helps pay the bills, basically. Funds operations, proves the tech works in the real world, diversifies customers while those big auto wins mature.
Okay, so unique tech, big markets. What stops competitors? What's their competitive advantage? Their economic moat?
Their main moat really is the technology itself, the IP, that proprietary FMCW LiDAR. It's fundamentally different from standard TOF.
It's not just a small improvement.
No, it's a distinct approach. That instant velocity advantage is key. And they protect it with a pretty hefty patent portfolio, had 78 granted patents by late 2023. That's a real barrier.
And those partnerships we mentioned, Daimler Truck, the top 10 OEM, SEK AG, that unnamed Fortune 500 tech firm, they add to the moat.
Oh, hugely. They create extremely high switching costs. Once you design a sensor suite into a major car platform or a complex industrial system that takes deep integration, software, hardware, endless validation.
Right, you can't just swap it out easily.
Exactly. Ripping AEVA's tech out and putting something else in. Incredibly expensive, time-consuming, years of rework, revalidation. So those partnerships lock customers in, at least for that product generation. Plus their massive validation signal shows big players are betting on AEVA, makes it harder for competitors.
So unique tech, patents, plus partnerships creating sticky relationships and validation. That maps out the business pretty well.
Yeah, that's the core story. Tech innovation targeting huge markets with a smart pivot to industrial to bridge the gap to big auto revenue down the line.
Chapter 2, Management Evaluation.
All right, let's talk about the people running the show. We know the co-founders. Soroush Salehian is CEO, and Mina Resk is president, CTO, and also chairman.
Their background. It's often highlighted they came from Apple's Special Projects Group. How much weight should we actually give that? Is it just good marketing or?
Well, it definitely lends credibility, That group at Apple, it's known for tackling really complex, cutting-edge stuff, requires innovation, miniaturization, executing under pressure.
Okay.
So while maybe not specific automotive or LiDAR experience from that group, it suggests they can handle sophisticated hardware and software development. And they've built a team around them with relevant experience, including their CFO, Saurabh Singha.
And the board of directors. There was a significant addition recently, wasn't there?
Yes, Daniel Gibson. He's the founder and CIO of Celebra Capital. Celebra is a major tech-focused hedge fund, and they've become one of AEVA's biggest shareholders.
So having their CIO join the board,
Yeah.
that's more than just owning stock.
Oh, yeah. It's a strong signal. Shows deep conviction, a desire for direct involvement in strategy and governance. It's not just passive money.
Let's look at how management's using the company's money. Capital allocation. A key metric is return on invested capital, ROIC. What's that look like for AEVA?
Right. ROIC measures how well they generate cash from invested capital. For a company like AEVA, still early stage, pre-profit, it's deeply negative right now.
Okay, which sounds bad, but
But you have to put it in context, right? They're pouring money into R&D, into scaling up. They're not generating positive cash flow yet. That's the plan.
so judging them just on negative ROIC misses the point.
Completely. For a company like this, negative ROIC just reflects that intense investment phase. I mean, they spent over $100 million on R&D in both 2022 and 2023, building the future tech.
So the real question is, are those investments paying off in other ways?
Exactly. Are they hitting milestones? And the sources suggest, yeah, they are. Getting major design wins, launching new products like EVE-1, building those strategic partnerships. Their CFO even said they're thoughtful in how we invest. And that recent $50 million investment from the strategic partner, specifically for production capacity, that's external validation.
Interesting. Okay, the classic management question. Skin in the game. Are the executives invested alongside shareholders?
But the co-founders certainly are. Soroush Salehian, the CEO, owns about 7%. Mina Resk, CTO and president, owns roughly 17%. That's as of early 2025.
So significant stakes.
Yeah, having a good chunk of their personal wealth tied to the stock usually aligns interests.
But when you look at the actual insider trading records, it gets a bit more complicated, doesn't it?
It does, and it's one of the more fascinating dynamics the sources point out. You see the co-founders, classified as executive officers, they've been consistently selling shares over the past year.
How much selling?
Over the last 3 months alone, executive officers sold over 1.1 million shares combined.
Okay, that doesn't sound great on the surface.
But here's the twist. Celebra Capital, remember, they own nearly 30%, so they're also an insider. They've been aggressively buying shares.
Ah, so founders selling, but a huge institutional insider buying heavily.
Exactly. It creates this founder versus fund situation. Founder selling could be personal financial planning, diversification after the stock ran up, paying taxes, stuff like that. Pretty common.
Right.
Celebra's buying, though? That looks like a calculated, high-conviction bet on the long-term future. They didn't just buy stock. They took a board seat, provided financing. It's strategic.
So what's the net effect if you look at all insider activity?
That's the key point. Over the last 3 months, the net insider activity wasn't negative at all. Celebra bought over 8.1 million shares. So the insider group as a whole had a net purchase of nearly 7 million shares.
Wow. So the headline, insiders selling, misses the bigger picture.
Absolutely. The analysis suggests Celebra's aggressive buying and deep involvement arguably send a much stronger signal about future potential than the founder's diversification sales might suggest concern.
That definitely adds crucial nuance. Changes the narrative significantly.
Yeah, it moves beyond a simple, potentially misleading headline.
Chapter 3. Financial health.
All right, let's get into the raw numbers. Bottom line. Is Aeva making money right now?
The clear answer from the source material, no,
Yeah.
not yet. Still very much early stage, growth focused, investing heavily for the future, not current profits.
Right. And the profit margins really hammer this home. Gross margin, currently negative.
Meaning it costs more to make the sensors than they sell them for.
At these early low volumes, yes. That has to flip as they scale up production. It's a must.
And operating in net margins, I imagine they're also.
Deeply negative, yeah. Operating margin is way down there. Think negative 1,700% to negative 2,000%, mostly due to that huge R&D spend and operational costs. Net margin, the final bottom line, also deeply negative.
So profitability is clearly years away. Is there any sign they're getting more efficient?
Yeah.
Controlling costs?
Yes, actually. That's a positive trend noted in the sources.
Yeah.
Q1 2025. They reported a 19% year-over-year reduction in their non-GAAP operating loss.
Okay, classy.
And for the full year 2025, they're guiding for a 10 to 20% reduction in operating expenses compared to last year. So it shows they're focused on financial discipline, even while investing heavily.
How's their balance sheet look? Do they have the resources to survive this investment phase?
Their balance sheet actually looks quite strong, which is crucial. Their current ratio that measures ability to pay short-term bills is healthy, between 2.88 and 3.2, a solid cushion.
Debt. That's always a big concern.
That's a major strength here. Aeva is effectively debt-free. Debt-to-equity ratio is near 0.
Wow, that's huge.
It is, especially in a high-interest rate environment. Gives them immense flexibility, reduces risk significantly.
And liquidity, cash on hand, access to funds.
As of the end of Q1 2025, they had $206 million in total liquidity. That breaks down to $81 million in cash and marketable securities, plus that $125 million credit facility from Celebra that they haven't drawn on.
So that gives them runway.
Yeah, the sources suggest this provides a multi-year runway, enough to fund operations and planned investments without needing to rush out and raise more cash soon.
Okay, strong balance sheet, but still burning cash to invest.
Right.
What's the cash flow situation?
Predictably negative. Free cash flow, that's cash left after operating, and capital expenses consistently negative. Over the last 12 months, they burned about $112 million.
Okay.
But again, context is key. It's not a surprise for a company at this stage. It's an intentional cash burn. Funding R&D, building out manufacturing capacity for those future big orders. It's the cost of growth.
Right, investing now for payoff later. Which brings us to the elephant in the room. Valuation. How is the market pricing Aeva right now? This is where it gets wild, right?
Yeah, it really does. For an unprofitable company like Aeva, PE ratio is useless. So we look at things like price to sales, PS. How much are investors paying for each dollar of current sales?
And ASPS.
It is extremely high. As of mid-June 2025, it was trading at over 100 times its trailing 12-month sales. Let's put that in perspective with some peers.
Yeah, let's compare, like Luminar or Innoviz.
Right. Based on the data provided around the same time, Luminar, ticker LEZR, was trading at a PS of about 1.8x. Innoviz, INVZ, was around 7.5x.
Wait, so 1.x for Luminar, 7.5x for Innoviz, and AEVA at 123x TTM sales.
Yeah, roughly 123x according to that data snapshot. It's an enormous premium.
What does that mean? Why would the market pay that much?
It means the market is signaling massive confidence in AEVA's future. This valuation isn't based on today's reality. It's pricing an explosive long-term revenue growth and eventual high profitability. It's saying the market believes that AEVA's tech and position are fundamentally superior, justifying paying way, way more per dollar of current sales based on what they expect years down the road. So how can we even try to assess if that expectation is realistic? The sources mention an educational DCF model.
Yes, a discounted cash flow model. It tries to estimate value today based on expected future cash flows. But for a company this early, this unprofitable, it's purely educational, highly sensitive to assumptions, not a prediction, just a way to frame what the current price implies.
What kind of assumptions went into that educational model? Had to be aggressive.
Extremely aggressive. It assumed huge revenue growth, starting near their 90% guidance for 2025, and then scaling dramatically to grab a big chunk of that multi-billion-dollar TAM by the early 2030s.
Okay.
It also assumed they hit profitability around 2028 or 2029, aligning with some analyst views, but still years out. And importantly, used a high discount rate, 11%, reflecting the huge execution risk.
And based on those specific aggressive assumptions, what potential value range did the model spit out?
If they hit all those marks, the model suggested a potential intrinsic value somewhere between $18 and $25 per share. But again, huge if, highly dependent on hitting those future targets perfectly. Okay, $18 to $25 based on a very optimistic scenario. That gives us a benchmark, at least.
Exactly, a benchmark to compare against the current price when we wrap up.
All right, that wraps up part one. We've looked at AEVA's core tech, the business model, the management team, their background, capital decisions, and the financial strong balance sheet, but deep negatives on margins and cash flow due to heavy investment.
Yeah, it's a picture of a company with definitely promising technology and significant investment backing, but still very, very early in its journey to commercial scale and profit.
Now that we've got that foundation, let's shift gears. Let's understand the market's view, Wall Street sentiment, ownership, and then take a really clear-eyed look at the major risks involved.
Absolutely. Understanding those external factors, the potential bumps in the road, is just as critical as understanding the tech itself.
Chapter 4, Market Sentiment.
So what's the general vibe from Wall Street analysts covering AEVA? What's the consensus?
It leans positive. The overall consensus rating tends to be moderate buy or even strong buy. Looking at the specific analysts mentioned in the sources, 7 of them, 5 had a buy rating, 2 were at hold.
And importantly,
No sell ratings among that group, 0.
okay. And what about price targets? Where do they see the stock going in the next year or so?
Well, following some positive news, several analysts actually raised their targets recently. The average 12-month target from this group lands around $16.32.
Your range.
A high of $18.90 down to a low of $11.11. Okay, average around $16. But here's the kicker. Where was the stock actually trading when this analysis was done?
Right. As of June 16th, 2025, AEVA's stock price was around $23.06.
$23. So trading way above the average analyst target, even above the highest target.
Exactly. Which tells you the market's collective mood, maybe driven by recent news or speculation, has pushed the price well beyond what the typical analyst currently thinks it's worth over the next year.
What's driving that? What's the general buzz around AEVA that's causing this disconnect?
Well, the recent news flow has just been overwhelmingly positive. You know, announcements about design wins, new products, certifications, those big partnerships.
Right.
This positive coverage seems to be generating significant buzz, especially attracting retail investor interest. You can see it in social media mentions, search trends, that sort of thing. And more retail interest often means more volatility.
Absolutely. That heightened buzz, speculative trading, sometimes fueled by algorithms, can definitely lead to sharp price spikes and just generally more choppy trading. Let's look quickly at the chart, some short-term technicals. moving averages.
Right. The 50-day and 200-day moving averages give a sense of short and long-term trends. As of mid-June 2025, the stock was trading way above both. The 50-day was around $12.79, the 200-day around $7.30.
So strong bullish momentum, both short and long term, based on those averages.
Correct. There's always a but in technicals. Another indicator, the Relative Strength Index, or RSI. It measures the speed and change of price movements.
Yeah. What did that show?
It recently signaled the stock was in overbought territory.
Which can sometimes mean a pullback is coming, right?
Yeah.
The price moved up too far, too fast.
Exactly. It suggests the rapid run-up might be a bit stretched in the very near term. Now, one more important sentiment piece. Short interest. People betting the price will fall.
What's AEVA's short interest look like? Is it high?
It's notably high, yeah. Sources put it as high as 19.4% of the float. That's the shares available for public trading.
Wow, nearly 20% bet against it. What are the implications?
Two main things. One, it means a significant chunk of the market, likely sophisticated investors, thinks the current valuation is way too high and the stock's likely headed down.
Okay, that's the bearish view.
But two, conversely, really high short interest makes the stock vulnerable to a short squeeze.
Ah, the squeeze.
Yeah. If the price keeps rising fast, those short sellers might panic and be forced to buy shares to cut their losses. That buying pressure just adds fuel to the fire, potentially sending the price even higher very quickly and violently.
So high short interest reflects skepticism, but also adds this potential explosive upside volatility, a double-edged sword.
Precisely. It really highlights that tension we keep seeing between the market's current enthusiasm and the underlying valuation concerns.
Chapter 5. Ownership structure.
Okay, let's dig into who actually owns AEVA stock. We know about the founders, but what about the broader picture?
Well, one striking thing from the sources is the very high insider ownership. Over 58% held by founders, the board, major early investors.
Which is generally seen as positive, right? Skin in the game?
Yeah, usually. Means those closest to the company have a lot riding on its success personally.
And looking at the big institutional holders, one name really stands out.
Celebra Capital LLC. They are by far the largest institutional owner, nearly 30% of the company. Others include firms like Canaan Partners, and the usual giants like BlackRock and Vanguard are in there too.
And we talked about Celebra's CIO, Daniel Gibson, joining the board. Their role seems much bigger than just holding stock.
Absolutely.
Yeah.
Celebra's involvement is way beyond passive. They've been aggressively increasing their stake, big open market buys, their CIO is on the board, direct influence.
Right.
And critically, they provided that $125 million financing facility.
That's serious commitment.
It is. It signals a deep strategic partnership, a powerful vote of confidence in AEVA's tech and strategy from a very savvy financial player.
Now let's loop back to that fascinating insider trading point from Chapter 2, but view it through this ownership lens.
Right. We noted the founders, the CEO and CTO, were selling consistently. Over the last 3 months, exec officers sold over 1.1 million shares.
The huge counterweight was Celebra Capital's buying. Remember, they're also an insider because they own over 10%.
Exactly. In that exact same 3-month window, Celebra bought over 8.1 million shares.
So while some key individuals were selling, this massive strategic institutional insider was buying hand over fist.
And the net result for the entire insider group, it wasn't a sell-off at all. It was a staggering net purchase of almost 7 million shares, overwhelmingly driven by Celebra. This completely reframes that insider selling narrative. It's not simply insiders are dumping stock. It looks more like founders diversifying, maybe, while a major, sophisticated, long-term backer builds a massive strategic position and gets deeply involved.
And arguably, that huge strategic buying from Celebra sends a much stronger positive signal than the executive selling sends a negative one, especially given Celebra's board seat and financing role.
That context is absolutely crucial for interpreting that data point correctly.
Gives you the full picture, yeah, based on the sources.
Chapter 6. Risk Assessment.
Okay, time for a reality check. No investment, especially a high-growth, high-potential one like this, is risk-free. We need a clear view of what could trip AEVA up. The sources give us material for a classic SWOT analysis. Strengths, weaknesses, opportunities, threats.
All right, let's start with the strengths. What are AEVA's core advantages?
Okay, number 1, the differentiated technology. That proprietary FMCW LiDAR, the instant velocity thing, that's key.
Right.
2, those high-profile strategic partnerships. Daimler Truck, the top 10 OEM, SCK, the Fortune 500 tech firm. They validate the tech, open doors to the market. 3, The asset-light manufacturing model lets them scale with less capital intensity. And 4, that strong balance sheet. Minimal debt, over $200 million in total liquidity. That's a solid safety net.
Okay, now the flip side, the weaknesses.
Yeah.
Where are they vulnerable?
Biggest one, the financial profile. History of big operating losses, profitability still years away. That leads straight to weakness number 2. High cash burn. They're spending heavily on R&D and scaling up.
And the valuation.
That's number 3, definitely. The stock's extremely high valuation is a major weakness.
Yep.
It prices imperfection, leaves zero room for error if they stumble on execution. And 4, while those big customer deals are great, relying on just a few for future large-scale revenue, that's customer concentration risk.
Makes sense. Moving to opportunities, where's the upside potential?
The huge total addressable market is the main one, beyond automotive, industrial, consumer, security. Big potential there. And specifically, expanding into those industrial markets offers a faster path to revenue, maybe better margins than the long auto cycles. And ultimately, if FMCW really catches on, they have a shot at real industry leadership, maybe setting a new standard.
Okay. And finally, the threats. What external factors could hurt them?
Competition is fierce. You've got established top players like Luminar, Innoviz, other companies trying FMCW, plus alternative tech like cameras. Radar keeps improving.
Sure.
Then there's massive execution risk, going from prototypes to flawless, high-volume automotive production. Incredibly hard. Delays, quality problems, cost overruns could wreck key relationships. And you can't forget the macro environment.
Right. Things like inflation could raise their costs for materials, labor, squeeze margins. Rising interest rates, especially tough for high-growth, unprofitable companies like Aeva. It hits their valuation hard because future cash flows are worth less today. And, global supply chain chaos, geopolitical stuff, tariffs, all that can mess with costs and logistics.
So yeah, a clear picture emerges. Company with really interesting potential, but facing some very significant hurdles to actually realize it.
Definitely. High potential, but matched by high risk. Execution has to be near perfect. Chapter 7. Conclusion.
All right. We've covered a ton of ground, pulling together insights from all the source material on Aeva Technologies. Let's try to synthesize what it all means.
Yeah, boiling it down, Aeva seems like a classic high-risk, high-reward story. It's built almost entirely on the promise of its unique FMCW 4D LiDAR tech and the bet that it can capture a really big slice of these massive future markets.
We can frame it pretty clearly with the bull versus bear argument.
Okay, the bull case. What drives the optimism? It's the differentiated tech, right? That instant velocity edge.
Right. Plus the enormous market opportunity: cars, industrial, consumer, security. Huge potential TAM.
And those blue-chip partnerships, Daimler, the top 10 OEM, that Fortune 500 tech firm, they validate the tech, de-risk the path to market.
Don't forget the strong institutional conviction, especially Celebre Capital. Aggressively buying, taking a board seat, providing that financing backstop. That's a powerful signal.
Okay, now the bear case. What are the big concerns? It starts with the financials, doesn't it?
Absolutely. Unprofitable. Deeply negative margins, high cash burn, profitability still years off.
And tied directly to that is the extreme valuation. Trading at that massive PS premium compared to peers. It basically prices in perfection already.
Yeah.
No room for missteps.
Plus the significant execution risk. Just scaling up to high volume, high quality automotive production is a massive challenge.
And that nuance around insider selling,
Yeah.
founder selling, raises questions. Even if it's largely offset by Celebre's buying, it's still part of the bear narrative.
Right. Now let's quickly circle back to that educational DCF model we talked about, just to frame the valuation piece.
Okay, that model used really aggressive assumptions, right? Multi-billion revenues, hitting profitability around 2028, 2029, high discount rate for risk.
And based purely on those optimistic assumptions, it suggested a potential intrinsic value range of, what was it, $18 to $25 per share.
And as of mid-June 2025, the stock was trading around $23.06.
So right inside that range, but definitely at the upper end of it.
What's the final takeaway comparing the current price to that model's output?
It suggests the market's high valuation is acknowledging Aeva's potential. The tech, the market opportunity, it's recognized. However, it also implies there's very, very little margin for error priced in right now.
Yeah.
The market is essentially betting that Aeva will execute flawlessly, hit those ambitious growth targets. The price today reflects the expectation of success, not the guarantee of it.
Well, this deep dive into Aeva Technologies, pulling from all the sources, has definitely painted a complex picture. Innovative tech, huge potential, key players making big moves, but also challenging financials and significant risks ahead. Hopefully this has been a useful shortcut for you, the listener, to get well informed on AEVA.
It's a really fascinating case study, a company trying to break through commercially in a tough, capital-intensive industry.
So, thinking about that high valuation and the execution risk needed to justify it, here's a provocative thought for you to mull over. Given everything we've discussed, what specific milestones, operational, commercial, tangible things, beyond just announcements, would you personally need to see Aeva achieve over the next year or two to feel truly confident they're on the right track to justify that current market price?
Yeah, that's the question that bridges the data to the actual investment thesis, right?
If you found this deep dive valuable, if it helped you cut through the noise, please remember to like and subscribe to the StockAnalytics.ai YouTube channel. Your support genuinely helps us keep creating this content.
And don't forget, members get priority. Just $4.99 a month lets you suggest the tickers you want us to tackle next.
And finally, the necessary disclaimer. This analysis was generated by an AI system using the source material provided. It's for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.